Hey, it's Rav. Welcome to the Everyday Investor TV show, the hottest investment show in the world. That's right, I said it. I don't care who knows it. Super excited about today's show. We're going to be talking to my good friends, Neil and Rachel Oliver from Clover Properties, and we're going to learn how to make money investing in the rent-to-own strategy, the lease-to-own strategy. Whenever you're faced with any type or introduced to any type of investment opportunity, you always want to ask 4 questions to start. Number 1, what's the return on investment? 2, when do I get that return along with the money that I put in? 3, what is the minimum investment amount needed? And 4, what is the risk, the worst case scenario? We want to help us grow our money. That's what the show is all about, helping us grow our money so that we can take our precious time, be able to spend it with family, friends, engage in a purpose greater than ourselves, all that kind of good stuff. Don't go anywhere. We'll be right back.
So I think the first and most important part is that we have to make sure that we're putting them into a program that makes sense for their credit. Right, giving somebody a 2-year rent-to-own term when they've just come out of a bankruptcy and need full 2 years to repair credit in the first place is probably not going to help.
Hey guys, Lee here, Wise Construction. May 18th, Sarah Larby, Ken Beckendam, and myself, Lee Pollock, we're putting on a masterclass at our shop, 979 Main Street East. And what we're doing is we are going to be talking about converting larger multifamily projects from commercial to residential. During this, we're going to show you guys and teach you guys and explain to you guys on how this works, the process, the particulars. We're going to talk about the financing, and we're also going to go and see some of these projects that we've done. We're going to talk about these projects that we've done, and we're going to talk about the numbers and how they work, and we're going to answer your questions. This is all good stuff. Hope to see you there.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey guys, Omar Khan here from Theta Trading, and today's topic is crypto. I get asked this question often. Hey Omar, do you invest in cryptocurrencies? And for me, the answer is no. I don't invest in anything that I am not comfortable with and that I do not fully understand. So for me, the world of crypto, and this may change down the road, but for me, at this point in time, it's still a very abstract concept. I don't understand the utility, and because of that reason, I find that there's better risk-adjusted returns that I can have elsewhere, and for that reason alone, I stay out. Now, that does not mean it's not the right investment for you, and I'll cite something that Warren Buffett said over the weekend, which again is a bit of a concern area for him. The Berkshire Hathaway annual meeting just happened this past weekend in Omaha, Nebraska, and Warren Buffett said that he wouldn't buy all the Bitcoin in the world, for $25. Now, that's his opinion. My opinion is I don't know enough about it, therefore I'm out. You make your opinion, but always, always understand what you're investing in and why you're investing in it. See you guys next week.
Hey, it's Rob. Welcome back to Everyday Investor. I'm with my friends Neil and Rachel. We're talking about rent-to-own strategies. Guys, it's great to have you here with me.
Thanks. It's great
live.
to be here.
Awesome to see you again live.
I mean, for the sake of production, this table is, keeping us apart. I wish we could get a little closer, hugs and kisses. But last time, we were really far apart. I mean, you, Neil, you did the show with me. You're in South America and doing it from there, right? And
It's much warmer.
Yes.
Much warmer.
Yeah, I mean, and what a time, right? I mean, you guys were still working, but the pandemic and, for me, mental health wise, I needed to get down south to feel like a human being and feel blessed that I was able to do that. Not everybody can do that, but welcome back. Here we are in 2022 in the spring, and you're still cranking. A friend of mine, Chris, I was talking to yesterday, is Rav, I love Neil and Rachel. We're doing this and we're doing that, and I thought he wanted my advice. So I'm saying, tell me about the deal and this and da 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 da. And after a few minutes, he goes, no, Rav, you know I've already signed the papers. Like, I don't need to talk. I said, then what are you calling? I just want to let you know they're great people, you know? And I guess they put the offer in, didn't get it, but you're still working with people. So let's talk about that for a second, Rachel. Like, here's Rav as an investor. I want to make money and be able to help friends like Chris and Hazel. How long can it sometimes take from the beginning to the time where we really have, acquired the property, somebody moves in? Like, it can, especially in the GTA with everything that's happening, bidding wars, I mean, I assume it can take how long?
Well, the rent-to-own strategy is great in that you don't have to factor in things like renovations. So that really condenses the time. But there are certain things that are completely out of our control, and that is, we're dealing with home buyers who need to rent-to-own, and they're house hunting, and Neil is supporting them through that process. But how often do they get out to look? How often do properties in their price point come up on the market? And then ultimately, how easily will the sellers accept the offers? So that cycle can be anywhere from 60 to 90 days, believe it or not. But not crazy when you think about how long can renovations drag on.
No, that's not long at all. I mean, you put money, in other places, and we've got to, if someone has a REIT or if somebody's doing an apartment building, and I want it to take time to make sure we're doing our due diligence, and so good things happen when we're patient, but that's great. So let's talk to the viewers a little bit about just the process, because there's three parties involved. There's Rav the investor. There's, let's use their names, we won't say their last names, but there's Chris and, there's Rav the investor, there's Jim and Susie, who are the tenant to become owner, right? Is that what we call them? Tenant owner?
Tenant buyer.
Tenant buyer. But then to be able to make this happen, we need Clover Properties. Is that the title? Is that what we're using?
We're kind of the glue. We're
Yes.
the glue between the tenant buyer that needs to rent to own and an investor who wants to help that family.
Yes, and what I loved about your guys' concept is, I know, Neil, you help that tenant buyer be able to buy that property in 2 years, 3 years, 4 years, whatever the terms and condition is, by helping them with their credit, which a lot of people don't do. So let me park there for a second. What kinds of things do we do to help somebody get their credit up to where they can, go on title and buy the property?
So I think the first and most important part is that we have to make sure that we're putting them into a program that makes sense for their credit. Right, giving somebody a 2-year rent-to-own term when they've just come out of a bankruptcy and need full 2 years to repair credit in the first place is probably not going to help. Any glitch along the way is going to put them in a situation where they don't qualify. So we look at how do we build out that program, number one, right? So if it's a 2-year, we give them a 3-year. Give a little bit of buffer. If they can buy early, we offer them the option in the agreement to buy the house at the price of the home at any point in time. So they have that flexibility 100%. Then we're looking at what do they need to do in terms of what have they been doing wrong and what do they need to do now to make that right. So if they've had late payments, then we want to work with them to make sure that they know that they can't make late payments anymore. This has to change, and we constantly are checking their credit. Probably every 3 months, we'll check their credit to make sure that we're starting to see trending in the right direction.
That's great.
Yeah, and then we jump on the phone every 3 to 4 months as well, just to have a quick conversation, answer any questions that they have, and just make sure that, again, they know what their role is in building up their credit, because their goal at the end of the term is to own the home.
Yeah, no, I love this. I mean, I done a few rent-to-owns way back in the day on a napkin with people I kind of knew, and it's not as sophisticated, and the I's weren't dotted and the T's weren't crossed, and so I really, appreciate this concept. Rav, the investor, doesn't necessarily have to talk to Jim and Susie, the tenant buyer, because that's what you're doing.
That's right.
Right? And what are some reasons, Rachel, like from the investor standpoint, I mean, the returns are, they're good returns, and I don't have to necessarily be qualified in terms of being governed by whether it's the Ontario Securities Commission or all these other regulations. What are some reasons for those that are watching, tenants that want to become owners, that want to become buyers, Rachel? What would be some reasons? I mean, I think maybe they want to be close to a family and there's a house for sale there, or a certain school, or what are some reasons that the tenant would enter into this, as opposed to just waiting and hopefully you know, I kind of already know the answer, but, you know, try to figure out their credit on their own and save money, or?
Yeah, if they wait and try to figure it out on their own, they'll never be as efficient as what Neil does behind the scenes. He totally underplayed all the work he does. He does a lot of heavy lifting to get people from not being able to qualify to being mortgage ready. So kudos to you. He does the hard part. But the people that really need the rent-to-own process are those that can't really level out on the GDS and TDS. So when you go to the banks are looking at you kind of in a little box, and they're making sure that you have a certain amount of credit and a certain amount of debt. And if you have a little bit more debt, say you bought a brand new car a year ago, you haven't paid it down enough. Say you finished school recently and you have student debt, you haven't paid it down enough. Well, for the banks, that's going to be a no-no, and they're going to turn you away. But for a great person who's has a great income and has been saving and maybe has 5% down, that is a perfect opportunity to go the rent-to-own path. And then while they're in the rent-to-own piece, they're actually paying down all of the debt. So that's what Neil was talking about earlier, that he's on top of them to make sure that they're hitting their milestones to become mortgage ready so that they can get back into that box with the lenders at the end of the term.
I think there's one other answer, and that would be the elephant in the room that you said, oh, I think I know the answer to that. What we're getting now is a lot of people who are, they're being asked to leave their home because their landlord wants to sell and capitalize on the market. Mm-hmm. They're looking at other rentals that are now $3,000 a month. And they're saying, well, I don't want to pay $3,000 for a rental that I'll never own, I'll never build equity in. Let's look at ownership. And when they find out that the banks won't accept them because of whatever credit, low down payment, whatever the situation might be, new job, they look at rent to own. And rent to own still gives them the opportunity, although they share a little bit of the equity with the investor, they still have the opportunity to build equity, make the home their own, do renovations, right? These are all the things that they can still do, I guess. They can do renovations in a rental, but would you? You're never going to see that money back. So this is probably the biggest reason right now is that a lot of people are finding out that they can't qualify, but they don't want to continue paying astronomical rents.
Yeah. So Rav's the investor. Rav's in this model, because it's very excitingly, I want to talk about a second model. Maybe we'll do that after the break. But in this model, Rav is the investor. Rav is on title. Mm-hmm. It's Rav's property legally. But in spirit, it's Jim and Susie's property. There's a pride of ownership. They want to get into the market, start building equity. They want to live near their friends. They want to go to this particular school. Well, for whatever reason, Jim and Susie are there. So we've laid out, Rav already knows what his return on investment is from day one, correct? Like we're already pricing out, okay, this is a 3-year term. At 3 years, they'll buy it from me from such and such price, so on and so forth. Like there's no guesswork in this.
No surprises.
Yes.
And full transparency, and again, I think that's kudos to Neil because he is very risk averse. And when we got started with real estate investing, he just kept shooting down every different type of strategy. And then this one kind of landed in a way that, okay, well, if I can predict exactly what kind of cash flow I'm going to make, exactly for how long, and what kind of rate of return I'm going to get, or what kind of capital gain I'm going to make, I think this is doable. And I think that was really the catalyst for Neil to say, yeah, rent-to-owns make sense because there's a lot of variables and a lot of lack of clarity about some of the other investment vehicles. And he wanted certainty. He wanted assurances. And there's no guarantees in real estate, but I think you got as darn close as you can with this. Yeah,
no, I think that's great. Again, it's a win-win for the investor and the tenant buyer. What I love about it is that they're putting some skin in the game as well. Like, never have I heard, I thought I would be putting, because it's under my name, it's an investment property. So here in Ontario, I've got to put 20% down. But some of these tenant buyers are putting 5, 10% down as well, which when you have skin in the game, you're very serious about this, as well as they're paying above and beyond what all the fees would be, mortgage, interest, taxes, so on and so forth. Yes, it all goes back to them, or a portion as a credit, but again, my ROI is significant. So let's talk about the ROI because it's kind of sounds too good to be true, although I have friends, personal friends, that are Danny and Jillian, now Chris and Hayes, people that are doing these deals with you. So talk about the returns, talk about how many people you've helped, and maybe, kind of give or take the exits that we've done so far.
Yeah.
Well, rent-to-owns, I think, going back to how when we got started, really were a cash flow play. And we continued that momentum to help other investors benefit. A lot of other strategies, you kind of park your money and you have to wait for, exuberant mortgage pay down to actually see significant tangible cash flow. And then you still have to endure all of the tenant and toilet crap, which we both are not very good at. So what we decided to do was, okay, let's make our investment strategy as cash flow rich as possible. And that's really the play with rent to owns. On a typical deal we recently did, the cash flow is around $1,300. And the cash flow variables change depending on whether you're using personal savings. So when we use our HELOC, our cash flow goes down to about $900 or $1,000 a month, which is still pretty darn good after all fees,
Very good.
expenses.
Yes.
That's the money we kind of can put in our pocket, pre-taxes. That's the only part that it kind of sucks. But if I'm making more, well, it's okay if CRA is making more too.
Yeah.
Yeah, and to date, we've helped well over 650 at this point, 650 families.
What?
Success rate's about
650?
Yeah, that's 12 years. We've been going a long time.
Wow.
Yeah, and we have a success rate about 91%. 91, 92%.
I like how finicky you get with those numbers. I just say 90%, he's like 91, 92.
Yeah.
And when you say that, I don't want people to think that 8 or 9% of investors lost their money.
Right.
So what do you mean by that when you
Right.
say 91%, 92%?
So I'm pretty proud to tell everyone that we don't have an eviction yet to our name. Basically, the 7 or 8 or 9% that have not made it through the program are usually divorce or separation.
Not the investor.
No,
Just to
like
clarify,
home
the
buyers.
Susies and Jims of the world on the tenant
Right.
buyer side, if they have a disruption in their relationship, they
Yeah.
cannot make the payments because one of them is
Yeah.
being booted out or moving out, and they need dual income.
Right.
Yeah.
And I'm not a marriage counselor, and Rachel could attest to that, so I'm not able to help with those situations. But we're very fortunate that the down payment, especially in this market, we're very fortunate because the appreciation has been so high.
That's right.
We just had one actually that fell apart after 8 months in Ottawa.
Yeah.
And the investor sold and actually made the same money he would have made on a 3-year rent-to-own term.
Yeah.
So-
Well, that's what I was going to say. I mean, again, not that we want this to happen, right?
Right.
Life's about relationships and helping and so on and so forth. The investors, most times, if not all times, does actually better if it doesn't work out. That's
right.
not the intention.
Yep.
We want it to be a win-win. No, this is amazing. Let's take a quick break and we'll come back. We're talking to my friends Rachel and Neil. We're talking about how we can make money from an investor standpoint with the rent-to-own strategy. We'll be right back. Don't go anywhere.
Hey, it's Kyle from the Kyle Ford Mortgage Team. I want to talk to you guys about what to do in a rising interest rate environment. I'll start with what not to do. Make sure you're getting advice from a person who represents you and your interests. Going to the bank that holds the mortgage is likely not the person that's going to best represent you in this decision. I want to give you an example here. What is a mortgage? A mortgage is a bond that's sold on the open market, which means when you go in to lock in your rate, you're not locking in the rate for your benefit, you're locking in a higher return for the bank's investor. These are the type of things that you want to be thinking about when making these decisions. Make sure you're working with an independent agent or broker that has your interest in mind. Ask about products like static variable, ultimate cap variables, or shorter term mortgages like a 2 or a 3 year. If the rates are keeping you up at night, make sure you're talking to a professional who can help advise on the best needs for you. If you have questions on how this works, don't hesitate to reach out to myself and the Kyle Ford Mortgage Team.
Blackjack Contracting Inc. is a premier contractor for real estate investors, having transformed over 250 single-family homes into multiple legal suites. Blackjack is proud to introduce their newest venture, reicontractor.ca. Check out reicontractor.ca to get support with planning, design, renovation services from the most experienced real estate investor contractors. reicontractor.ca, powered by Blackjack Contracting.
Hi, David Smith here from the Q Theta Fund. Do you know there's a way that you can buy high-quality businesses like Apple and Microsoft and get paid anywhere from 1% to 4% a month, sometimes even more, just to agree to buy the stock at a lower price than it's currently trading at? At the Q Theta Fund, we use this proven strategy. We own high-quality businesses that continue to grow their earnings and revenue. So if you're interested in investing like this, like many other investors you watch on this show, then contact me at my email right here.
Hey, it's Rav. Welcome back to Everyday Investor. I'm with my friends Neil and Rachel. We're talking about how to make money in the rent-to-own strategy. Yeah, guys, I mean, this is a really great thing. I didn't realize it's 12 years. But let's just kind of recap, because I want to talk about this second model that you're introducing. So Rav, the investor, with you guys, let's, hypothetically, I've done 6-7 deals. And now I've run out of title. The bank won't let me do these anymore. I mean, the returns, I'm making, give or take, combined everything, about 30%, annualized returns with this model. It's really good, but I have no more title, and that's a lot of liability, perhaps, anyway. So says the bank. Okay. So now you have something else for me. So I can't qualify anymore because I've done, too many, but I still want to invest with you with the rent to own. Tell me about this new strategy.
Well, it's exactly what you just described. When you run out of capacity and you want to continue to create that cash flow, because you're pretty much addicted to that cash flow, right? You're making about $1,000 to $1,100 a month in cash flow,
yes,
and you don't want to turn that tap off. So how do you do it when you can't qualify for any more mortgages? So the method is to come in with us as a partner and park your cash. So a recent deal in Guelph on an $800,000 property. For you, that's going to be a little bit tricky right now because you can't qualify for a purchase of $800K.
Yes.
So in this case, there's about a $640,000 mortgage, and we're going to take on that liability, and we need about $167,000 from you to do the cash component. So you park $167,000 in there, and you're going to be making about $790 a month in cash flow, and you don't have to worry about qualifying for a mortgage. And
so you're on title?
We're on title.
Wow. So what? So I don't have any more title, but you guys need 15% or 20% or whatever it is of the purchase price. Mm-hmm. Rav has that. It's kind of like a joint venture, really. I'm giving you guys the money. You guys go on title. You guys take liability, so on and so forth, and then I get a return from that, significantly. The big part, I mean, obviously debt reduction and increase, but cash flow. I get to keep my cash flow, but you're on title.
Exactly. So if it's a 3-year deal, I believe the Guelph deal was 3.
Yeah.
So on that 3-year deal, you're making about $28,000 in profit, but you're getting it each month as $790 in cash flow. How about that?
Yeah, no, that's fantastic. I mean, that's for somebody. So you're doing both. We have. If I have room on title, I'll go on title. You'll hook me up with Jim and Susie. I guess I shouldn't say that in today's culture. Hook up. No, no, you're not going to hook me up. Right. You're going to introduce me to Jim and Susie. We're going to do that. But if Rav runs out of title, I've done 6-7 properties with you guys. The bank says no more. Then I can lend you. Lending, partnering, whatever we call it, and I can still make the cash flow. You're on title, you take the liability.
There you go. And that's not all, Rav, actually. Beyond the cash flow, which is really great, and a lot of people love the cash flow, we also split that equity 50%, right? So 50-50. So profit from sale, let's just say it's $30,000, we split that. So that added to the cash flow then ends up being what they get back at the end of the deal when the deal closes. Okay,
so it's really this is a true joint venture. I'm giving my money, you guys are taking care of everything. The difference is it's not a long-term tenant, or we're not revisiting in 5 years. We already have the exit before we start, and Rav's doing this because the bank says no more Rav, but Neil and Rachel say we can do it with you, Rav.
But wait, there's also one important consideration. There's more.
Yes.
Wait, there's more. So for a lot of investors like us and like you who are constantly putting our money into different investment opportunities, in our case it's usually rent to owns, but in your case you're a little bit more diverse. So what's happening is that we're running out of cash and we turn to refis and pulling equity to do more investing. Well, a lot of investment strategies don't lend themselves well to using HELOC money because there's an interest cost. So think about this deal that we're just talking about partnering on, where you're making $790 a month in cash flow. Well, if you were to use your HELOC, you would still be able to make cash flow at around $450 a month.
Yes.
So no qualifying for a mortgage and not even using your own capital, and you're still making $400 plus.
And is this cash money, or is there mechanisms that we can use for registered funds as well?
Absolutely. So the other component is that there's a first mortgage in the mix. So that's where registered funds would come in. And it's interest-only payments. And actually, one really important distinction is when you're using registered funds, sometimes there's a lot of administration and things can fall through the crack. So we wanted to eliminate that risk and that contingency. So what we did was we brought in a third-party administrator that's going to handle all the statements, all of the payment processing, all of the reports for accounting. So it becomes fully turnkey. You literally close your eyes, park your money for 3 months if you have registered funds, and boom, you grow that RSP.
Yes. 3 months, 3 years.
For 3 years.
3 years.
Or
yeah.
4. Some deals
Yeah.
are 4. What are you seeing more, trends of 3 year or 4 year?
More for.
4?
But I know in advance.
Yeah.
I know what it is. I mean, and that's what I like. We're not just kind of hoping. And, it's pricey in Metropolis. So where are kind of our boundaries? Like we're, with these, I can't believe that many. What do you say, 600?
650 plus.
Wow.
Yeah.
Where's the furthest from the CN Tower?
Where is the furthest?
Yeah.
Probably Windsor.
Windsor, okay.
Currently,
Okay.
I mean, Windsor,
Not that far, 3 hours, 3.5 hours,
we
yeah.
still stay in fairly built-up areas. We
Yes.
don't go out into rural country because it's very difficult to make that work.
Yeah.
But we are right now in the process of expanding into Quebec.
Okay.
And we're also expanding into Alberta. So we're going to be having a situation where we've got the higher priced homes in Toronto, and then we also have maybe more reasonable priced homes in Alberta and Quebec that we can offer up. So yeah.
No, it's really smart because, when people ask me about, the Canadian real estate market, I mean, there's really no such thing, right? We
That's
know
right.
as investors, we've been doing it for a long time. It's area specific. So, yeah, if Canmore, Alberta is, a place to be, then that's a place to be, or Edmonton, or, Trois-Rivières in Quebec, so that's great.
What's important to remember for all investors who do rent to owns is that you also have a stake, or they have a stake. The tenant buyers have a stake in the deal, right? So you're not buying a home in Canmore and then you're not familiar with the area and you're hoping
Yeah.
everything works out. Well, these people have picked the home. They
Yeah.
put 3 to 5% down, in most cases 4 to 5%. They've got a stake that they can lose if they choose not to proceed.
Yeah.
So as an investor, for me anyway, because again, I am very risk averse, I'm very conservative, that was really, really appealing to me.
Yeah.
I don't have to worry about them running away from the home like a rental situation where they midnight move or they just stop paying because I've got their money.
Yeah.
And I own the home.
And the tenant buyer, Susie and Jim, are responsible for maintenance and repairs. I think that was another really important consideration in us thinking about how are we going to do these deals? If they're 3 hour, 6 hour, 7 hour drive or a 2 hour flight from us, how do we minimize our risk and exposure? Well, the tenant buyer handles maintenance and repairs, so we're off the hook.
Yeah. What, do the investor and tenant buyer ever, maybe on exit, do they kind of, share a glass of wine or?
To be honest, there's
Yeah.
some investors who want to be in the mix the entire time. They go to the home inspection, they meet them at the home inspection, they might even want to check in with them from time to time, send them a bottle of wine when they close.
Yeah.
And then there are others who want to be completely hands-off. And
Yeah.
we really leave it up to the investor, right? I'm not going to limit an investor who wants to be a part of the experience. So
Yeah.
definitely, yeah, there's some that get right in there.
No, that's great. And so part of the team is we have a realtor, right? You guys have
Correct.
realtors in these areas
Yep.
that you're working with, and it's you have a relationship with, and
Yep.
and so how are you finding it? Again, here we are, spring 2022. With the bidding process, are we kind of starting to see it change a little bit? I mean, I'm seeing it's kind of softening, a pinch in the GTA. Not significant yet, but kind of your crystal ball. Where do you see us in 3-4, like the summer or the fall?
Yeah, we have seen it soften a little bit. I mean, we've been closing a lot more in the last couple of weeks than even the week before. So we're starting to see 3 offers instead of 15.
Yeah.
But we still have the situations where there are insane buyers who just go ballistic on the price, and we're like, we can't even compete. There's no value.
Yeah.
Like, you can't compare values of what these people are offering in some cases. So we just, in that situation, it's not the right house.
Yeah.
So we keep looking. But we usually, so back to Rachel's timeline, it was 30 to 90 to 60, 90 days, right? Is what you said, basically,
Yeah.
for an investor. But
Yeah.
in some cases, we found a house in a week.
Yeah.
So it can turn
All
over
depends.
really, really quick. Yeah.
Yeah.
It's area specific.
Sure. Listen, guys, time flies when we're having fun. This is
Yes, it does.
fantastic. You have your original model that you've done 600 to 700 deals with, and never did the investor lose. And I think that's fantastic. And then you have this new model that, if I'm capped, to get mortgages, I can partner with you on deals and make some money as well. Thank you for being on the show. Really appreciate it.
Thank you for having us.
Yes.
Thank you.
Thank you guys for watching. Without you, we would not have a show. Make sure you tune in next week, same place, same time. If you want to watch this on demand, go to our YouTube channel, subscribe there. Honey, I love you. I'll be home soon. Bye, everyone.